Okay, I'm going to go over a few of the in-class problems for Chapter 8. So number 35, we have the translation of the financial statements. So they give us below the financial statements of the subsidiary company that are in the British pound. So we've got our income statement, statement of retained earnings, balance sheet, and cash flow statement. And then they give us the relevant exchange rates. So our first step is to translate the income statement, statement of retained earnings, balance sheet, and statement of cash flows into US dollars. So again, here's my, over to the left of this PowerPoint or this picture, I have our end of the year rate is how we translate our balance sheet, average rates, how we translate the income statement, historical rates go into our common stock and our paid in capital. Our dividend rate is for our dividends on the statement of retained earnings and on the cash flow statement. And then our property, plant, and equipment acquisitions and our debt acquisitions or debt borrowings are on the cash flow statement. So that kind of maps out all those different numbers that they give us. So we start with the income statement. So again, we take their income statement off of what was given to us over here to the left, and we are going to translate that and multiply it by our average rate. So each line item is multiplied by the $1.46. So then our translated income is $490,560. Now then our statement of retained earnings, like I told you in the PowerPoint, that's going to be given to us. So our beginning balance, it tells us of those statement of retained earnings is $984,198. So we don't have to compute that. But then we have to understand how the statement of retained earnings works. So our net income funnels down from the income statement into our statement of retained earnings at that translated amount. And then we're going to translate the dividends. So going back to their statement of retained earnings, the dividends are 33,600 British pounds multiplied by the dividend exchange rate of $1.48, and we'll subtract that out. So then we've calculated our ending retained earnings balance, which again, think back to financial accounting, that rolls into our balance sheet. So we notice that, see how that goes down into the balance sheet. Now then, as we look at the balance sheet, all of our assets are translated at the end of the year rate, the $1.50. So take the British pound value times the $1.50 gives us our translated number. So do that line by line, all the way down until common stock. Common stock is going to be at that historical rate of $1.23, and so is the paid in capital. And then again, like I said, the retained earnings we don't compute. We roll it down from our statement of retained earnings, and then we look at it to say, okay, we have our total assets. We know our total liabilities and equity need to equal that. So what I have there in the green is a plug. So it's saying our cumulative translation adjustment needs to be $1,015,770 to make this balance sheet balance. Now then the cash flow statement, our operating section is all calculated or translated over at our weighted average. Our change in property, plant, and equipment has the actual exchange rate on the date that we made the major purchase, so the $1.47. Same with the debt, that's the same date at the $1.47. Dividends are at that $1.48. And then again, we're going to do our cash flow statement same way we did in like financial accounting. We've got our cash from operations, our cash used in investing, our cash from financing. We will add those three together to get our change in cash. But then we realize that our beginning of the cash balance is coming in at the beginning of the year rate. Our end of the cash balance is coming in at the end of the year rate. So there's a difference. So then we need to make this all balanced so that our change in cash added to our beginning balance equals our ending balance. So then we're going to have a plug of the 42,330, which is the effect of the exchange rate on cash. So there'll always be a plug there as well. Okay, then we'll go down to the next part. So then, is that the end of that problem? No, that is the end of that problem. Okay, so that was just strictly translating those financial statements into US dollars, all three of them. Then this one, we're going to translate the financial statements into US dollars from euros, and then we're going to consolidate them. So the first part of it's going to be the same as what we just did. They give us the income statement, balance sheet, statement of cash flows of the subsidiary company in euros. Then we have our exchange rates, and they'd like us to translate those. And then, so if I look, let's see, do I have that? Yeah, so that's just what's right to the right here. So then I've taken the income statement, I put it in Excel to make it go a little quicker. But then we're calculating the exchange rate at the average rate for our income statement to get to our net income. Then our net income rolls down into our statement of retained earnings. The beginning balance is given to us in the problem. And then our dividends has its own rate. So we go back to their statement of retained earnings, multiply that by the translation rate, and that gives us our dividends. And then notice that the ending retained earnings balance rolls down into our balance sheet, just like we learned in financial accounting. Then our balance sheet, all of our assets and our liabilities, those are translated in at the end of the year rate. Our common stock and paid-in capital are translated at that historical rate. And again, we want our assets to equal our liabilities and our equity, so we have a cumulative translation adjustment. So it needs to end at the $1,563,005. Now they tell us over here in the problem, it has a beginning balance of $1,817,088. So then the difference between those is going to be the change for the current year. And we'll eventually get into that. So then now they give us the income statement and the balance sheet for the parent. And then they say, assume the following information. The purchase price for the subsidiary included an asset relating to land that the parent estimated was worth $384,000 more than the book value at the time of the acquisition. And then, so we're going to have to factor that in. Compute the balance of the equity investment account, which again on the parent's book shows $7,208,400. And then prepare the translated financial statements, again using this as what we just calculated here above as our subsidiaries numbers. So then we come down, so what I've done here on the board is kind of mapped out what they wanted us to do. So we're reconciling out our equity investment, so our common stock, our paid-in capital, and our beginning of the year retained earnings, those are going to come right off of our translated statements. So the common stock, additional paid-in capital, and our beginning of the year retained earnings are those values there. And now I've just traced them down onto the board. Now then our beginning of the year cumulative translation adjustment was given to us. So if I go back up into the problem, they tell us it's $1,817,088. So then that is where that comes in. And then notice though they tell us it's a debit balance, so it's going to go the opposite direction of these equity accounts. So then that gives us our $5,443,200. Then we've got the land. So the land is $384,000 at our beginning of the year rate, which again go up to the table. Our beginning of the year rate's $1.20. Our end of the year rate is $1.25. So then our land value is going to go up by that 5 cents, and really nothing happened other than the exchange rate. So then that $19,200 difference is going to be recorded as a translation adjustment related to that land. And then our equity income and our dividends are the same. We're going to pull them right off of here. So our equity income the equity income's right off of the parent statement. 1,147,000. Let's go down there. Yes, so that's right off of the parent statement. And then the dividends are going to be right off of the subs. So the $116,659. So that's where that number comes from. And then this current part of the translation adjustment is going to be what we have mapped out up here. So what they gave us the beginning balance, and then we determined what the ending balance has to be in order for that balance sheet to balance. So that means there's a $254,083 difference that needs to be recorded. And it would be a credit, so it's going to go the same direction as our income. So then when we add those three together, we get our equity investment. So then we know that we map those out. And then again, we do the same thing we've done in all of our other chapters. The equity piece of it creates our E entry. So the only thing that we're adding now, though, is we credit the equity investment, but we also credit that beginning of the year cumulative translation adjustment, again, because it was a debit balance. If it were a credit balance, we'd have to debit it. So again, pay attention to which way, if you have that on your test, which way that goes. Then we're setting up the land at the beginning of the year value, because that's always what our A entry does. We are eliminating our equity income and our dividends, but then now we're also eliminating the current year portion of the translation adjustment. Now it is a credit, so we have to debit it. The change was a credit. And then our D entry is going to bump the land up to the ending of the year value. So we're going to increase the land by that $19,200, and then that is going to go into our equity investment account. Now I feel like the book may summarize it in with the the translation adjustment. They add an extra little table in the middle here that I don't do, so that's a little bit different. I kind of streamline it all into our regular statements that we have. But then you can see we have our same things, our E entry eliminating common stock paid in capital, beginning of the year retained earnings, and now the beginning of the year translation adjustment as a credit. Then our A entry is setting up the beginning of the year land to the credit of the equity investment. Our C entry eliminating the equity income, the dividends of the sub, and then our current year piece of the translation adjustment. And then the offset goes into the equity investment. And then now see, I'm putting that D entry into the equity investment and increasing the land, because it really isn't depreciation. It really truly is just a change of that cumulative translation adjustment to bring up the value of the land, and that is currently being hung up in the equity investment. So then it zeroes the equity investment out. Notice then our cumulative translation adjustment is equal to what it should be to get the entry, to get the balance sheet to balance. Our equity income is zeroed out. Our equity investment is zeroed out. Our statement of retained earnings equals our parents. Our net income equals our parents. So all of our double checks work. So all that we've added, though, is just this extra cumulative translation adjustment, and then that it adjusts our E entry for the beginning of the year balance, the C entry for the current year balance. So that's really the key. And then, of course, knowing how to translate the financial statements into US dollars.